going to take a look at the Ben Felix 60/40 portfolio, something that you might want to move your investments to before retirement, or at least, at the start of it. Now, I just want to start off by saying in this video, I am not in any way attacking Ben Felix. He is doing a fantastic job at educating investors. He is taking, theories and papers that these brilliant people have wrote and, spreading them out to the world. And, if you're new here, basically every time I say, hey, this is what this person's doing, I'm going to show you a little bit better way how to do things. So, Ben is doing a great job of, answering the question, okay, who wrote this? What are we doing? Why are we doing this? He answers those questions. Even in his one video, he says, I have the ability to make these videos because he can. And you know why? He's not connecting the dots. He's answering the first half of the questions for you so you can figure out the last half. So what I do is say, okay, what are we buying it? How are we buying it? And when are we buying it? I'm answering those last three parts of your questions. And basically, I'm trying to use simpler language. I find myself even pausing and rewinding a bit when Ben spits out some numbers. Basically, the guy's a genius. I love some of the comments that he gets. It's just like, he's a robot. I'm going to invest like a robot. This is why I made the calculators. The calculator's a robot. It's rule-based. It's AI. Basically, I'm charging so low for it. It is supposed to go viral. If I keep getting these terrible comments that attack me down below, I'm going to charge what the product's worth. I know exactly how much money you're going to save. I know exactly how much more money you're going to grow. I know how many taxes I'm going to save you. Basically, I could charge $10,000 for each download of this product, and you're going to still come ahead from any other financial advisor. So please help me go viral. Share this, because I don't want to charge all this money for the product. Basically, it is made to help the average investor. It is made to help my generation. I feel a lot of the comments, if I drop an F-bomb or here and there, you're a boomer. I'm not really trying to help you. If you're on YouTube trying to find financial advice, I'm honestly scared for you. Basically, you probably need an advisor to help you pull more money out before you buy more covered call ETFs. So anyways, let's get into it here. So Ben's recommending ZAG for just the bonds, which I've mentioned in so many times that I like spreading out your fixed income. It's just safer. The app has a tactical asset allocation, algorithm. It's going to shift your money over here when this is doing better. Shift your money over here when this is doing better. In a lot of videos I've said don't balance it to the letter of the law. But if the app is saying, if you have, 20% of your portfolio in a long term, and then all of a sudden it's telling you to put 20% in a short term, you should probably make that change. But the idea behind it is you're an individual. You're independent. It's your money. You want to do what you want to do. I can only convince you as much as you'll let me. So when we go to the Canadian portion, XIC is what Ben chose. The Vanguard Total Market, I like the S&P 500. Now we're also putting in some American products, the Avantis Small Cap Value. They mention a lot. I don't know if I can't remember if it's FAMA or something, but yeah, basically a small cap value. Like, small cap companies grow. They're not established yet. If you buy the ones that are, bringing in revenue and, lowering their PE ratio pretty fast, that's the company that you want to buy. When we look at XEF, that's the EFI. We're looking for companies overseas. That's another Canadian one. Now, if we look at AVDV, the International Small Cap Value, I don't even think Canada has a product. Maybe that's why Ben put it in there. And when we look at XEC, I mean, I don't like emerging markets as a whole. I would rather everyone just put their money in India. It's the #1 growing economy. It has the most amount of people. They are super friendly people. Every one of their parents has bricks of gold. They know how to manage money better than North America, in my opinion. So what we're going to do here is we're going to take all of Ben's percentages for the 60-40 split, and I'm going to help you build 2 more portfolios. So in the, let's just do it portfolio by portfolio. So this is, again, what I just said for Ben. And yeah, like I like VAB. You know, there's no difference between those two really in the end. You know, they're going to trade places, but yeah, I just like that one. ZLB for my Canadian allocation. I like the S&P 500, VFV. We're going to use RWJ. This is Invesco's small cap product. Basically, it's revenue. It's looking at companies growing their revenue. ZEQ, we have Europe's high quality, and we're going to use DXJ. This is Japan's instead of the international small cap. And we're going to use ZID for India for portfolio 2. Now, to build out the portfolio a little more with 10 funds, you know, just like how I recommend on the app, we're going to split it up a little more. So instead of using VAB, we're going to build it out with PSA, a high interest savings account. There's basically no risk on this money. We're going to use gold, GLDM. I believe this has the best 5-year number on the market currently. It just hit its 5-year birthday. It has a lower fee than GLD. I mean, that's why it's outperforming GLD. Same thing. And then we're going to look at the FlexShares iBox 3 target tips. I like a short-term tips, you know, during a downturn. Basically, the shorter term your bonds are when the bond market is fluctuating, the less volatile that product is going to be. Bonds are meant there to be safe. Basically, yes, they can lose as well, but let's say you had someone had all their money in stocks at the beginning of 2022 and all their money, and someone else had all their money in bonds at the start of 2022, the person who had all their money in bonds did better. Basically, yes, you lost, let's say 10%, but guess what? Losing 10% is better than 20%. You have to understand once in every 5 years, you will lose your money. Like, it's gonna happen. It's bound to happen. You've seen these drops at the boom, 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 down. Like, it just happens, okay? And we don't know when this is going to happen, but as it's happening, my algorithm helps you find, okay, now it's better to, like, okay, move your money over here, move your money over here. It's a robot. It doesn't have emotions. Basically, it takes the emotions out of investing, and that's what you need. You don't need to be emotional. And we're going to use ANGL. This is the Fallen Angel product. This is basically what happens when, you know, a company could be, let's say, AAA, and something happened and it went down to a BB. Basically, what happens with these Fallen Angel products is when they drop, you know, a lot of people just sell out of these bonds, which creates more downward pressure. And then this company is buying them when they're like at that lower rate, when they're undervalued after they've lost their credit rating. Like, that's how that one performs so well as a bond. So we're going to look at how all these 3 perform. The first one is Ben. The second one is me not splitting out fixed income. And the third one is me splitting everything out for you. Now, when we look at this, AVUV is, I mean, it's a great product. I think it has the best 3-year number on the market right now, but it has not a lot of history. So we can only see back to the start of 2020. And to be honest, that's a great example. It's basically showing us, okay, how did everything happen just after that quick drop? You know, the COVID drop. How is everything going to perform just after a downturn? Now you can see here, Ben's portfolio is 60-40, performed 4.71. There's nothing wrong with that performance after 2 downturns we just saw in a short amount of time. I mean, that's gonna beat a bank mutual fund. There's no ifs, ands, or buts about it. That's, he's giving you great information. It has a low standard deviation. Unfortunately, Ben has the worst year and the highest max drawdown. And these are kind of low Sharpe and Sortino ratios, in my opinion. I mean, it's still a great portfolio, but yeah, let's use some investments that are on the app. So we have, or both apps, some of these ideas are from the American app. I mean, just so I can make sure, hey guys, I'm not doing anything crazy. I'm kind of taking Ben's investments and just kind of giving you my investments. I'm trying to make you money. I'm trying to speed up the process. So when we don't split up the bonds, we have a 6.16 compound annual growth rate, a lower standard deviation than Ben's, a better best year, a better worst year. This one actually has the least amount of max drawdown. I don't know if that's because of the gold or the fallen angel product, might have to do with that, why the max drawdown's lower over here. But yeah, we're seeing a great Sharpe ratio, a great Sortino ratio. Now, why I love putting gold in my portfolios, I mean, I got a great question yesterday from it. It is the oldest financial instrument that has been around for a couple millennium. It's been around for thousands of years, and it has, slowly but surely over that long time, it's combated inflation. In a giant downturn, the app might tell you to sell out of your gold, and you'll be like, why? Because your gold's still up. Then it's going to give your bonds a little more time to recover. You don't have to sell out of just your cash every time religiously. Basically, sometimes it's better to sell out of certain things. And when we look at the last portfolio, we've got an 8.19% compound annual growth rate over 2 downturns with a 60-40 portfolio. This number right here beats every bank mutual fund in Canada's 100% equity portfolio. Would you rather be invested 60-40 and have basically no volatility compared to the all equity portfolio? A standard deviation of around 11 after 2 quick downturns is so low. So low. We recovered amazingly with a 60-40 portfolio during 2021. I mean, see that growth? See the yellow gold? And we have the least amount of worst year. Basically, see how it didn't lose that much? Right there, compared, these had larger dips. Now the max drawdown, it's still better than Ben's. But again, he's mentioned it in his videos, and I can 100% confidently agree. It says right here on his things, for illustration purposes only. Actual client portfolios may be different. Now he said some of the investments within his podcasts. You have to catch these things. So I believe they're using the dimensional global fixed income. That's basically what I'm helping you do, splitting all these bonds up. We're using American, we're using Canadian, we're using another American. Basically, that's your global. When you see global, that's going to be, anywhere from 50 to 60% US, and then everything else is going to be kind of spread around. That's what the word global means. I mean, they're not always going to be 50 to 60% American. Sometimes there might be more. But essentially, that's kind of what the industry average is. So, yeah, basically, he's unveiling how he's building these portfolios for his clients. I believe they have $1 million minimum at their practice. And what I'm trying to say is, hey, I'm trying to help the guy with 10 grand. I'm trying to help the guy with 5 grand. I'm trying to help people in my generation who don't have access and will never have access potentially, or won't have access to these people for 20, 25 years. And guess what? This is the best time for you to compound your money. If you don't have good advice at the early stages of your investing, you're going to either have a hard time to retire or have a shitty time, or have a terrible retirement. The sooner you start investing on your own and the sooner you start compounding your money without paying all these fees, the better. So, I hope you learned something today. Basically, share these videos with your friends. I'm not going to be making Canadian content for the next little bit. And I've mentioned it in the last video. I have 2 sisters. I just taught my one sister in Canada how to get rich. I just taught my other sister with the last video, starting her how to get rich, video by video. She went to Toledo, Ohio on a full soccer scholarship. And she stayed in America when she met Travis. That's basically it. I am going to help everyone in North America get rich if you'll let me. All right, hopefully you learned something. Take care.